Hi everybody, Jeff Yasteen here. You know, the trick to playing chicken with the stock market is knowing when to flinch. And when it comes to shares of Facebook, I think now is the time to take the money and run. If not now, sometime in the next couple, 3 weeks before or just after the 4th of July. If you're new to the stock market, this is going to be one of the hardest things that you'll ever learn to do, which is selling into strength. That means making your exit while there are still plenty of buyers for your stock. You don't want to wait around so long that it's back to the time when you see somebody like CNBC's Jim Cramer scared and ranting on television before you then decide that you will also hit the sell button. So when it comes to Facebook stock, why sell now? Well, one, there are lots of other companies out there with promising growth, yet have not made their big move. Two, this stock has made its big move, a very big move for a company that's worth more than $660 billion by market cap. It's one of the 5 largest in the world. And Facebook is up 37% since I practically shouted, from the internet rooftops that I can't believe Facebook is this cheap, and that was back on March 10th. I also followed it up a few weeks later and said, I still can't believe that Facebook is this cheap. So if you bought then, or if you happen to buy for a 60% gain, if you bought when the stock bottomed out at $139 a share a week later, well, you're doing really well. But that was then, this is now. Facebook stock now isn't exactly cheap. It's not cheap at this level. There are different ways to measure cheap and expensive in individual stocks. There are many ways. All of them have their flaws and their advantages. None of them are going to turn you into Warren Buffett overnight. But a simple method is just a good old price earnings ratio, a PE ratio. You take your favorite stock's current price per share, then look up what the company is expected to earn for its annual earnings per share, let's say for 2021. So that is presuming that your favorite stock actually has profits. There's a lot of companies on the NASDAQ these days that have no profits whatsoever. And that presents also a bit of trouble going forward here. Anyway, divide the stock by the annual earnings per share, and presto, you have a PE ratio. In Facebook's case, it's on track to earn $7.57 a share over the next 4 quarters. That gives the stock a PE ratio of 31. Now that happens to be Facebook's highest PE ratio since 2016. And when we talk about expensive and cheap, what we're really saying is whether you're owning the most expensive house in the most expensive neighborhood, in the most expensive zip code. When it comes to the stock market, you want to be owning the not so great house in the most expensive zip code. Those are the ones where you're getting the best value and you're buying at a price that allows more room for appreciation. That's no longer the case with Facebook shares, especially after we've seen this 60% rise, as I had suggested buying back in March. So, as I noted a few weeks ago, I think there are a lot of major tech stocks that are in the process of topping. Microsoft is priced at its highest level, also a PE ratio of 31. That's its highest since the dot-com boom 20 years ago. And I think it's highly likely that major Wall Street investors are slowly selling into strength in this broad market rally that we've seen since late March. And they're rotating their funds into other undervalued post-pandemic stock plays for the next few years. So we're talking about travel, leisure, airlines, yes, even cruise lines, but basically you're talking about many companies that have not really participated the way a lot of these tech stocks have. And you know what, while I have you here, let's do a little technical analysis of Facebook shares as well. So this is Facebook stock, and this is what we're looking at if I zoom out just a little bit here. So this is Facebook stock over the last roughly 18 months or so. And why would I be saying to sell the stock now? Well, let's just zoom out even further. So this is showing us Facebook shares basically since the IPO in 2012, you can kind of see it right here. You can see this point here where lots of people kind of doubted whether Facebook was really a stock to buy or not. And then the shares have risen very, very nicely over the last 7 years, 6 years or so. They peaked out here July 2018. Then we had this broad sell-off through the second half of that year as plenty of investors kind of panicked over whether the U.S. economy was going to hit a recession. And that was a point, frankly, where the Federal Reserve began to cut interest rates a tiny bit. Then we have this huge rebound through 2019 to a peak there in late January. And then the worries over the pandemic hit. I call it the coronavirus panic. And you can see here that the stock bottomed in March. And in fact, the exact bottom was March 18th, where it fell as low as around $137 a share. So why sell the shares now? Well, as I mentioned before, there's concerns over valuation issues. When you're owning a stock that is really at its highest valuation as a relatively mature company, that is something to be concerned about. Doesn't mean the stock's going to go down, 50% or 60%, but could it lose 30 or 40%? Yes, under the right conditions. The other thing here is that I don't like is taking a look at the shares over basically the last month or so. You can see here where the stock came right up to the 230, 240 level really, and saw plenty of sellers push it down that day. Then we had the stock move sideways for a bit, made another run up to 240. That was on June 9th. And what happened? The next day, it actually opened above that, around 241, 240.90 and change, and it fell. Then we have this small sell-off here to the 224 level. Now it's back to roughly the 235 level. So why sell it? Well, as I'm talking to you today, the NASDAQ is up around 1.3%. It's up about 118 points as I'm talking. My concern here about Facebook and frankly a great many large tech stocks is that there are large institutional sellers that are coming in and selling at these points here around 240. They are not letting these stocks make new highs. And if you look at other stocks, and let's bring up Microsoft because I wrote a piece a handful of weeks ago about expecting a 30% decline in Microsoft shares and suggesting it would be a good short. And look at what we see here. So once again, on June 10th, we see this run with Microsoft setting new all-time highs, a sell-off for a couple of percentage points, a rebound here from the 184 level, and yet today with the NASDAQ up 1.3%, this is the best that Microsoft can do as a stock. To me, again, all of this points to institutional sellers. This is the sort of thing that you see at real tops for specific stocks or specific sectors where institutions are in there saying, hey, when it gets this level, they're not selling everything. They own hundreds of millions of shares. So you can't sell that much all at one time. So what they're doing is they're selling a little bit here and a little bit there. They're selling into strength. And that's what institutions need in order to move their money, liquefy their profits from being locked up in these big tech stocks and basically move it to cash so they can invest it someplace else. I think that's what's going on here. And I think that all investors need to pay close attention to their technology shares and make sure they do not get caught up in what could be large sell-offs to come as institutions move their money in even bigger ways out of these stocks while they still can and before there's a lot of selling pressure. Something to keep in mind as we go forward here. If you like what I'm talking about, make sure to follow me on Twitter and on social media and to keep subscribing to our YouTube channel, Smart Profits Daily. I'm Jeff Yasteen, wishing you the best of goodbyes.